They told you it was over. They told you Friday was the top. They told you to take profits and run. And like always, they said it with confidence. The kind of confidence that only exists when someone needs you to believe them. But then Monday happened. And the market didn't whisper. It didn't hesitate. It didn't test support. It screamed. Silver opened green, violently green. And in a single hour, it erased an entire bearish narrative that had taken weeks to construct. This wasn't a slow grind higher. This wasn't retail enthusiasm. This wasn't a dead cat bounce. This was panic. Silver ripped higher by nearly $2 from the open, printing levels that most traders had written off as impossible just days earlier. By the time the market had settled into the morning session, silver was trading north of $69, having tagged highs near 69.40. That is not normal market behavior. Commodities do not move 3% on a Monday morning without something breaking. They don't gap up and refuse to look back unless there is urgency, unless there is fear, unless someone, somewhere, is trapped. What we are witnessing is not a trade. It is a liquidation. To understand why this matters, you have to understand what happened last week, and more importantly, what didn't happen. The setup. They thought would work. Going into Friday, the positioning in silver was aggressive, extremely aggressive. Short interest had built up quietly over weeks, hidden behind calm price action and carefully managed volatility. Banks, funds, and large players believed they had control. The narrative was simple. Silver had run too far. Momentum was exhausted. Retail was late. A pullback was inevitable. So they pressed. They shorted the highs. They sold strength. They leaned on the market, expecting gravity to do the rest. And for a moment, it looked like they were right. Friday closed without fireworks. No breakout. No collapse. Just enough ambiguity to convince shorts that the top was in and the danger had passed. That weekend, the message went out. Take your profits and run. Because when the people who control liquidity want you out, it's never for your protection. It's because they need the exit. Sunday night. No hesitation. Markets technically open on Sunday night when Asian sessions come online. And what happened there should not be ignored. There was no dip. There was no pro blower. There was no test of Friday's close. Instead, silver gapped up. Immediately. This is critical. In technical analysis, when a market gaps higher, it usually comes back down to fill the gap. That's how markets breathe. That's how liquidity resets. But this time, silver didn't look back. It opened high and stayed high. This is what technicians call a gap and go, and it is one of the most dangerous patterns for anyone positioned on the wrong side. Because once price refuses to retrace, it signals only one thing: urgency. Someone needs to buy. Now, the shorts are underwater. By Monday morning, it became clear what was happening. The shorts were trapped. Anyone who sold silver on Friday was immediately underwater, and not by a few cents, by dollars. In leveraged markets like futures, that kind of move isn't uncomfortable. It's lethal. When losses accelerate that fast, traders don't think. They react. They hit the market buy button with both hands. This isn't strategy. This is survival. And when enough short positions are forced to cover at the same time, price stops behaving like a market and starts behaving like a vacuum. Up becomes the only direction. Why $70 is different. Silver approaching $70 isn't just a number on a chart. It's psychological, structural, existential. For years, the $70 level has represented a line in the sand, a point beyond which suppression narratives collapse and control mechanisms begin to fail. Above $70, the math changes. Risk models break. Margin requirements explode. Algorithms flip from selling to chasing. This is why you're seeing panic before the level is even reached. The shorts know what happens if 70 breaks, because 70 is not resistance. It's the point of no return. Algorithms are watching. Two modern markets are not run by humans reacting to price. They are run by algorithms reacting to thresholds. And $70 is one of those thresholds. Once breached, automated systems are programmed to do one thing: buy. Momentum funds chase. Trend-following systems activate. Volatility expands. This is how orderly markets turn disorderly. Not because of emotion, but because of code. And when machines take over in thin conditions, price doesn't move logically, it moves violently. This is why banks are nervous. Banks are not afraid of volatility. They are afraid of losing control. Silver is a small market relative to equities or bonds. It doesn't take trillions to move it. It takes imbalance. And right now, imbalance is everywhere. Physical demand remains tight, inventories are strained, leverage is stacked on one side of the boat. When price starts running in that environment, banks can't simply sell more to cap it. Doing so only adds fuel. Every short becomes a future buyer. Every attempt to suppress creates more pressure. This is why the reaction has been so sharp. This isn't bullish enthusiasm, it's defensive panic. Liquidation, not speculation. Let's be clear about something. What we are seeing is not retail piling in. It is not speculation. It is not hype. It is forced buying. Positions are being closed, not opened. Exposure is being reduced, not added. This is the market violently correcting an imbalance that should never have been allowed to grow this large. And when liquidation begins, it doesn't politely stop at technical levels. It overshoots. The silence is telling. Perhaps the most important signal of all is not price, it's silence. The same voices that confidently called the top on Friday are suddenly quiet. No victory laps, no smug commentary, no "I told you so." Because when a trade goes wrong at this scale, the last thing anyone wants is attention. They want out, quietly, before the rest of the market realizes what's happening. Control isn't slipping, it's gone. Markets are about perception. Control exists only as long as participants believe it does. The moment that belief breaks, price reasserts reality, and right now silver is sending a message. The suppression failed, the shorts miscalculated, the exits are crowded. And we haven't even reached 70 yet. There is a reason markets hesitate near certain numbers. It's not superstition, it's not coincidence, it's memory. Markets remember pain, and silver remembers $70. For years, that level has existed as an unspoken boundary, a place where positioning becomes dangerous, narratives fall apart, and risk stops being theoretical. Traders don't talk about it publicly, but internally, it's flagged, modeled, stress tested. Because above $70, silver stops behaving like a managed market. It becomes a problem. Why $70 is a psychological weapon. Psychological levels matter not because of charts, but because of behavior. At $70, several things happen at once. Long-term shorts go deeply negative. Margin requirements increase automatically. Hedging costs explode. Volatility assumptions break. This forces a choice: add capital or close the position. And in stressed conditions, most choose survival. That is why buying accelerates before the level is breached. Traders don't wait for confirmation when they already know the outcome. They front-run their own fear. What happens? When $70 breaks, if silver trades cleanly above $70, not a wick, not a spike, but acceptance, the market enters a different phase. This is where algorithms take control. Momentum models flip long, trend systems activate, volatility targeting funds rebalance. None of these systems ask why price is moving. They only ask how fast. Once those thresholds are crossed, buying becomes mechanical. It doesn't care about fundamentals, news, or sentiment. It only cares about direction. And direction, at that point, is up. The vacuum effect. Thin markets behave differently under stress. Silver is not deep like equities. Liquidity thins quickly as price rises because sellers disappear. No one wants to stand in front of momentum when shorts are being forced out. This creates what traders call a vacuum. Price jumps from level to level, skipping bids, ignoring resistance. Not because demand is infinite, but because supply vanishes. And when supply vanishes, price has no choice but to rise until it finds sellers willing to absorb risk. That's how markets overshoot. That's how $70 turns into $75 faster than anyone expects. This is why waiting for a dip stops working. In normal conditions, markets retrace. They breathe. They pull back to test support. But in liquidation-driven moves, dips don't exist. Every pullback is met with forced buying. Every pause becomes an opportunity for trapped participants to escape. That is why dip buyers don't board to even realize they rebuying into panic, because panic looks like strength when viewed from the outside. The key difference? Strong markets invite sellers. Panicked markets repel them. Right now, silver is repelling supply. Historical parallels. They don't like talking about. This isn't the first time metals have behaved this way. We've seen similar structures during past stress events, moments where positioning became too one-sided and price snapped violently against consensus. In every case, the move didn't stop where logic said it should. It stopped where pain finally forced balance. That's what markets do when they reset. They don't negotiate, they punish. Why banks are watching. Every tick banks don't panic easily. But they are highly sensitive to nonlinear risk, situations where small moves trigger large consequences. Silver near $70 is exactly that kind of risk. Because beyond that point, exposure grows exponentially. Hedging becomes expensive. Liquidity dries up. Public narratives lose credibility. Most importantly, confidence erodes. And once confidence erodes, control evaporates. The narrative is already cracking. Listen carefully to how commentary has shifted. It's no longer silver is overbought. Now it's silver is extended. Then it becomes silver may consolidate. These are linguistic retreats, subtle changes in language that signal uncertainty. When conviction disappears, positioning follows. That's when exits crowd. Retail isn't driving this, and that matters. One of the most dangerous misconceptions right now is blaming retail enthusiasm for this move. Retail doesn't gap markets higher. Retail doesn't force margin calls. Retail doesn't trigger algorithmic cascades. This is institutional, which means the consequences are institutional too. Losses don't disappear. They transfer. Why this move feels different. Markets have rallies all the time, but this one feels different because it lacks comfort. There is no clean pullback, no orderly consolidation, no polite rotation. Instead, there's urgency, and urgency is never random. Urgency is the sound of something breaking quietly behind the scenes. The countdown effect. As price approaches $70, every tick matters more. Shorts know this, banks know this, algorithms know this. Time compresses. Decisions that could have waited weeks now must be made in minutes. That's when mistakes happen. That's when control is lost. Silence becomes strategy. You'll notice fewer bold predictions now, fewer confident calls. Silence becomes a defense mechanism, because when outcomes become uncertain, visibility becomes liability. No one wants their name attached to the wrong side of a historic move. The market is setting the terms. At this stage, narratives no longer matter. Only price does, and price is sending a message. This move is unfinished. There's a moment in every market cycle when denial ends, not with an announcement, not with a headline, but with behavior. That moment arrives when price stops responding to reassurance, when it ignores expert commentary, when it shrugs off overbought warnings, when it keeps moving, not because people want it to, but because they can't stop it. Silver is entering that moment now. This is the phase where markets stop pretending they are rational and start revealing what they really are. Systems of pressure, leverage, fear, and forced decisions. And once this phase begins, there is no clean exit. Why $75 exists before $70 breaks. Markets don't move in straight lines, but they do move with anticipation. The reason traders are talking about $75 before $70 is even breached is not optimism. It's inevitability modeling. Institutions don't react to levels after they break. They model what happens if they break, and the models are ugly. Above $70, silver enters what risk desks quietly label a low elasticity zone. That means price increases require exponentially less capital. Each incremental dollar up causes more stress than the last. That is how $70 turns into $75, not through enthusiasm, but through absence. Absence of sellers, absence of confidence, absence of control. When control fails, psychology takes over. For years, silver has been treated as a controllable market, managed volatility. Predictable ranges, comfortable suppression. Participants became conditioned to believe that rallies would be capped and sell-offs would be orderly. That conditioning is now being weaponized against them, because when people are trained to expect control, they position aggressively. They add leverage, they sell volatility, they assume stability, and when stability disappears, the unwind is violent. That is exactly what we are seeing. This is what a real short squeeze looks like. A real short squeeze is not loud at first. It doesn't start with headlines screaming to the moon. It starts with silence, with spreads widening, with bids stepping higher, with offers pulling back. Then comes the behavior shift. Shorts stop adding, then they stop defending, then they start covering. Not all at once, but enough to tilt the balance. Once that balance tips, the squeeze feeds itself. Every forced buy lifts price. Every lifted price forces more buys. That loop does not require belief. It only requires math. Why fundamentals don't matter right now. This is uncomfortable for analysts, but necessary to say. At this stage, fundamentals are irrelevant, not because they don't exist, but because they are no longer the driver. Liquidation does not ask about supply and demand. Margin calls do not consult macro outlooks. Algorithms do not read balance sheets. They respond to price, and price is responding to pressure. Fundamentals will matter again later, when the market stabilizes, but stabilization comes after excess is purged, not before. Right now, the market is purging. The hidden fear, loss of narrative. Control. One of the least discussed risks for large institutions is narrative failure. Markets are easier to manage when participants believe a story. Silver is volatile. Silver always pulls back. Silver can't stay above X. Those stories reduce participation. They anchor expectations. They create predictability. But once price violates those stories repeatedly, belief erodes. And when belief erodes, participation changes. People stop selling rallies. They stop trusting resistance. They stop listening. That is when markets become dangerous. Why media will lag. This move. By the time mainstream coverage acknowledges what is happening in silver, the move will already be advanced. That's not incompetence, it's structure. Media reacts to confirmation. Markets react to imbalance. By the time confirmation exists, imbalance has already done its damage. This is why you should pay attention to what isn't being said yet. No urgency, no warnings, no serious discussion. That silence is temporary. The moment, after $75, let's be clear, $75 is not a target. It's a consequence. It represents the area where the current liquidation wave likely exhausts itself, not because price becomes expensive, but because enough positions have been cleared to restore two-sided trade. That restoration is messy. Volatility spikes. Ranges widen. Confidence remains fragile. This is not where stability returns. It's where chaos slows down. What happens to late shorts? Late shorts always suffer the most. These are the traders who waited for confirmation that price was too high, who sold strength believing they were being disciplined. They weren't. They were late. Late shorts enter during maximum stress, when upside acceleration is strongest and risk-reward is worst. Historically, this is where the most dramatic losses occur, not because of poor analysis, but because of timing. Markets punish hesitation more brutally than conviction. The illusion of taking profits. As volatility rises, advice will shift. You should take profits. Don't be greedy. Protect gains. This advice sounds reasonable, and often is, but it also serves another purpose. It creates supply. It encourages selling into strength, relieving pressure for those who need exits. This doesn't mean you should ignore risk management. It means you should recognize when advice aligns conveniently with institutional needs. Why this feels uncomfortable. Even for bulls, one of the strangest aspects of liquidation-driven rallies is that they make everyone uncomfortable. Bears are terrified. Late shorts are panicking. Even longs feel uneasy, because the move doesn't feel earned. There is no consolidation to lean on, no structure to trust, no rhythm, just motion. That discomfort is a signal. It means the market is not in control, and neither are the participants. The role of fear in price. Discovery. Fear is not irrational. It is informational. Fear tells you where risk is concentrated. Fear tells you where leverage exists. Fear tells you where exits are narrow. Right now, fear is asymmetrical. It exists overwhelmingly on one side of the trade. That asymmetry is why price continues to rise. This is how suppression ends. Suppression doesn't end with a bang. It ends with exhaustion, with repeated failures, with widening cracks, with small embarrassing losses that turn into large, undeniable ones. Eventually, maintaining control costs more than letting go. And when that calculation flips, price is released, not gradually, all at once. What comes after the run? Every violent move creates its opposite. After the squeeze exhausts, volatility will remain elevated. Price discovery will take time. Narratives will be rebuilt. New ranges will form, higher than before. This is how markets reset, not by returning to old levels, but by establishing new ones. The most dangerous assumption right now is that this will behave like before. It won't. Markets change regimes quietly, then suddenly. Silver is in the middle of that transition. Old rules are being invalidated in real time. Control was an illusion. Control always is. Markets tolerate management until they don't. They accept narratives until reality intrudes. They obey until pressure exceeds patience. Silver has reached that threshold. Final thought. This move will be studied later, analyzed, explained, rationalized, but in the moment, it feels like confusion. That's how you know it's real. Because real market events are never obvious while they're happening. They only become obvious after they're over. And this one, it isn't over yet.